Good afternoon and welcome to the webinar. I'm James Mulvihill, Vice President of Business Development at IBISWorld. Today's webinar will cover concentration risk, the credit cycle, and better lending decisions. Just some housekeeping items before we get started. We've automatically muted your phones. If you do have any questions, please use the questions box, and time permitting, we'll address those questions at the end of the presentation. After the presentation, you will receive a recording of the webinar and any materials discussed during the session. If you're an IBISWorld client or a prospective client, please visit ibisworld.com to contact us for more information. As a side note, there's also one CRC credit from RMA. In order to receive credit for this, please contact your RMA representative. Joining us today is Dr. Rick Buczynski, Senior Vice President and Chief Economist at IBISWorld. Rick is responsible for IBISWorld's commercial lending and banking, financial, and risk rating practices. Joining Rick is Kent Kirby, the Senior Credit Policy Officer for Commerce Bank in Kansas City, Missouri. He's responsible for reviewing, providing credible challenge, and establishing or updating policies and procedures used across the bank's various commercial lending platforms. Without taking too much of your time, I'm going to hand it over to Rick.
James, thanks very much. And Kirby, thank you for joining me.
Good. I'm looking forward to it.
We've got a lot of stuff to cover here. We're going to try to keep this to about 30 or 35 minutes. If we go over to about 40 minutes, that's a little bit too long, but we have three basic sections of this that we're going to cover today. I'm going to start by going over some of the basics of concentration risk. I don't think there's anything here that's going to be particularly surprising to you, but I've got a bunch of examples from my real world experience of working with banks over the last 10 to 15 years. Then I'm going to turn it over to Kirby, and he's going to give you some more practical, practical examples of how Commerce Bank has addressed some of the issues that I'm going to present. And then I've got just one short, kind of a cookbook, one slide on how to sequence the procedure to deal with concentration risk. So let's just jump in head first to the deep end of the pool. And in my travels, current methods for managing concentrations suffer from several deficiencies. I think a couple of the most important is first, bank systems fail to adequately address concentrations, particularly in the mapping of hidden or latent risks across lines of business. In this presentation, I'm going to provide some examples. But they also fall short in developing meaningful early warning systems and scenario analysis tools. Kirby, I know that you're going to illustrate some of the stuff that Commerce Bank has done and some of the wish list of stuff that you'd like to do in the future. The second major qualm that I have here is few banks manage concentration risk within an ERM, enterprise risk management function. So managing concentration risk and a bank's risk appetite suffer as a consequence. The next 2 points here as an introduction really are stuff that I've heard from senior regulators that spoke at IBISWorld sessions at RMA conferences. And the first is that many banks kind of trivialize regulations and intra-agency guidances on risk management issues. You might see in parentheses I have this over and under segmentation. Let me explain it. Some banks, particularly large banks, over-segment their lines of business in order to feign diversification, often leading to matters requiring attention. I've been involved in a couple of those naughty MRAs. On the other hand, small banks don't have the scale to diversify, and many are concentrated in small geographic areas. That's a real challenge. I know we have some smaller banks on this call today. So finally, few applications use concentration risk, early warning systems, and scenario analysis tools to find new business opportunities. So these are all the things that we're going to cover in the next half hour or so today. So here are some of the fundamentals of concentration risk. I think you all know, what I'm talking about here. I'm talking about credit risk, operational risk, market risk, liquidity risk. Examples of concentration risk on the operational side is concentration of vendors. Market risk, example is concentration in currencies. Liquidity risk, concentration in funding sources. We know that there's a lot of correlations along this ERM chain. We're not going to deal with those today, but you can see the white paper that's going to be coming out. You'll get an email on this after the webinar. So check this out. There are other risks that we're not going to handle today. Reputation risk is certainly a case in point nowadays. So what we're going to really hone in on today is going to be credit risk. So I'm going to be talking about single name concentration, industry concentrations, common factor concentrations, concentrations along the supply chain, and a couple of special factors. So I'm going to deal with these kind of one by one, and then I'm going to rely on Kirby to kind of fill in the blanks when I hand the baton over to him. Single name concentration, this is kind of I'm a storyteller, so let me tell you a story. This is one that I heard from one of IBISWorld's banking clients. So think of a family. She's a dentist. She has a C&I loan. I mean, she's got a lot of equipment in her office, costs a lot of money. So she has a C&I loan, conventional business loan. But she also owns a strip mall where she operates the practice. So, here's another silo, owner-occupied CRE. He, much different business. Her husband owns a small financial advisory firm. They booked the business with him, and because of the size of the bank, they didn't really have a line of business where they could put it, so it was kind of defined as a catch-all, mezzanine line of business. At the same time, both of them had a couple of car loans and a home equity line of credit. Maybe that was to finance one of their kids' student loans. What a morass of linked risks that are often neglected given banks' reporting silos. This can be, as many of you know, a real mapping nightmare. Industry concentration can be a little bit easier to deal with, but here's an example, and this I heard from another client down south after a tobacco plant went under. Its lender didn't realize it held many of the mortgages and car loans of the bank's the plant's former employees. Talk about latent risks. They totally underestimated risk appetite. The last factor is pretty important. So think about common factors as either drivers or key risk indicators. These are often neglected or hard to identify. Kirby, I know you're going to address this later on. For example, certain borrowers are more sensitive to specific risk indicators than others, factors like interest rates, energy prices, and trade policies. Consider the case of an impact of an increase of 30-year mortgage rates on industry performance, and here's the example here. So I've got a common factor which happens to be 30-year conventional mortgage rates. IBISWorld actually, in some of the databases that we have on Excel files, has identified a kind of a top 40 list, which has CCAR and DFAST type of variables. So here's an example of some selective industries that are most impacted by common factors. And there's a whole long list of them. This is just a summary here. And we know that there are many more industries along the supply chain. And speaking of the supply chain, I took the example here of auto parts manufacturing, and I think this is a good one. And we also have some tools, simple spreadsheet tools in this area as well. So they have supplying industries, and all these industries are kind of the inputs to their production for auto parts. Then they have their end markets or their key buying industries. So there are upstream considerations and downstream considerations. So a particular bank might have exposures in both areas, and that defines supply chain concentration. What would really be very cool is to integrate supply chain factors with common factors. I picked oil prices as an example. So key driver here, the price of oil. This is a key risk indicator. It can influence auto parts manufacturing, but there are other hidden unmapped exposures that might be unaccounted for. So a bank might have exposures in these areas, not only auto parts manufacturing, but maybe upstream in iron and steel manufacturing, and downstream in car and auto manufacturing. A point that I always like to raise is that, you know, concentrations aren't always bad. They can define if you're really strong in a particular area, like auto parts manufacturing, if you have expert judgment or institutional knowledge, then maybe you can leverage that knowledge to look upstream and downstream in terms of lending opportunities. This stuff is not rocket science. I have several clients of a fairly substantial size and some that are actually quite small that have integrated these systems given some of the spreadsheets that we have. If you have coding and mapping, and if you understand NAICS, this stuff is not rocket science at all. Some of the special factors are, we're not going to get into today, geographic concentration, particularly for the smaller banks, related to our collateral clusters, especially on the real estate side, product concentration, et cetera, et cetera. It's kind of a prototype. Here's an example that I've seen probably 2 or 3 dozen times on various banks that I work with. It's a large spreadsheet. You often see them at credit committee meetings. It's really, really huge. I gave an example here, and this is really an example of early warning systems, or sometimes they're called heat maps. And they have several sets of variables here, the first being key risk indicators. A lot of our clients will use our risk ratings, industry risk ratings, which we define on a 5- and 6-digit NAICS level. They might look at our risk trends. We have a volatility index. These might be part of these key risk indicators. OCC members might use their industry indicators, and we coexist with other external data that might come from other vendors. The key performance indicators, this is a very long list. This goes out forever. In fact, this spreadsheet probably has a font of about 4 or 5. It's about 1/4 of an inch thick. But there's data. These are the key performance indicators of the bank on exposures, delinquencies, charge-offs, all the way down. Basically, at the end of this section of the spreadsheet, you might see some recommendations in terms of limits, concentration limits, some policy suggestions. Maybe they're, you know, this industry is going to be a hold for the next quarter in terms of new exposures. And then this column here is basically industry groups that are rolled up, which I'll show in the next slide. So you'll have, this is mostly on the commercial side. You'll have these roll-ups and these definitions, and I'll give you an idea on how to do these in a second. But what's interesting here is that a lot of clients, let's take healthcare, for example. Healthcare is a real important business segment for most banks. But if you have a large exposure in hospitals, it might be broken out in terms of segmentation from healthcare. Roll-ups, you know, I always suggest the OCC's taxonomy. There's 21 industry groups here, has mappings to all the 5- and 6-digit NAICS. The last one was updated. It's public information. If you need to get a copy of it, I'd be more than happy to email it to you. In fact, I run into a lot of non-banks, non-OCC banks, that this is a starting point from those roll-ups. And by roll-ups, I really mean what we looked at on the previous slide here. Kirby, I'm going to hand over the baton to you.
Hey, good morning, good afternoon, all of you.
We have feedback.
Okay, is that good? Okay.
Anyway,
I will say that we are a non-OCC bank. We're a state chartered Fed member bank, and we do use the OCC taxonomy. We have a problem in looking at portfolio or concentration analysis, and that is that it's really hard to find decent forward-looking indicators. My analogy is we tend to go to the graveyard to look at the future. We tend to look at things like non-accruals and charge-offs, watch lists, and stuff like that. And I think it's a struggle with all banks to figure out how do we find something that's a forward-looking indicator that can add value to our concentration analysis. A lot of banks have tried macroeconomic factors, but those are really hard to integrate into any sort of model without some advanced econometrics. And I'm a historian by training. I'm not an economist, and so that's kind of out of the picture. And then I think a lot of other banks have spent a ton of money on CCAR and DFAST models, and so there's a pressure primarily from their executive to use those models to kind of jam into concentration analysis, and they really serve a different purpose. And so I think those different scenarios just don't work very well. And the one that does work doesn't. And the one that we tend to think works is a PD model. And most of us have some sort of a PD model, whether it's external or internal. And the problem with that is that it's really designed for single obligor rating only. And when you try to bring it up to a portfolio level, it gets really clunky to do so. And also, at the end of the day, it's really a financial factor of the companies that are in your portfolio. It's not some sort of external or industry analysis. It's just an aggregation of your financial data. And so that's kind of where we were. And so in trying to figure out a way to go forward, we started looking at the IBIS heat map. And to make a long story short, we've come up with a scorecard based on that heat map. And full disclosure, I did not create this. We have a very sharp young man in our shop that did this. But it's really based on the IBIS heat map. And you can see this, it's objective. We use the factors such as the risk score, the risk volatility, revenue growth. One of the key points in this thing is the demand and supply links. One of the things we found coming out of the last recession is that things tend to boomerang around your portfolio. Things are not as clean as they think, as you think they are. And trying to understand what those boomerangs are becomes the real challenge. And using those links in the IBIS heat map help quite a bit. And then we weight those, and then that comes up with about a 75% weight, primarily based on the IBIS scores. And then we have some qualitative factors, and there's really three of them. And the first one is the existence of business disruptors. And that's clearly things like, Uber to taxis and stuff like that. But I think you also have to look beyond that. And that's really where it kind of gets creative and trying to figure out what are the disruptions. So, for example, we have a lot of agriculture in the Midwest, and the tariffs are a disruption, primarily in beans, but it is a disruption. And so how's that going to affect the industry? And so it's not just technology. It's any sort of, whether it's legal or legislative or political or policy or whatever, you really have to try to figure out what kind of factors are going to be disruptive to that industry and what kind of weight you want to put to that. And then the second is technological dependence, and that's just simply it's an industry that requires a lot of development of R&D expenditure in order to develop and to continue to exist and remain competitive. And then the last one is really our experience with that industry, and it's really a combination of things. Number one is how much exposure we have or our historical performance with that industry, and then also whether we have internal expertise. So we have a couple of what we would consider, I think most people would consider to be fairly volatile industries, but we have a lot of deep expertise in those. We've done them for decades, and we have a pretty good understanding of the risks that are involved and how to mitigate those risks. And so even though it might be a volatile industry and show high volatility in the other factors, we would lower that through these qualitative factors and to reach an overall score. And then do you want the next slide, please? So the first way we've done this is actually on single obligor concentration. And what we basically are doing is replacing an existing industry benchmark, which is primarily based on financials and quite frankly, stale data because of its, a year's previous financials that we were benchmarking, and now going to this industry scorecard. And so what we're really looking at are the industry strengths and weaknesses. Where are we in the life cycle of this industry, where they are on the supply chain, what are the trends, the outlooks, and the overall attractiveness. And so that weight comes to about 20% of our overall single obligor scorecard. So it's not overwhelming, but it's certainly significant and can move the needle either up or down depending on where it is. And just to give you an example, if you have a good company in a kind of a lousy industry, like a good company in, let's say, the book industry, for example, is it a good company or is it a bad company? And the question is, well, it's a good company. And the answer is, well, it's a good company in a bad industry. And so that helps us to try to balance that out to really understand what the overall risk of the borrower is. And we've been working through this, and so far it looks like it's working pretty well. In the next slide, really some of our wish list items. One of the ones that we're really working on, we have concentration limits like most people do. I think sometimes they're a little more goosey than we really want them to be. Sort of, like I like this industry and I don't like this industry. And so what we're really trying to do is remodel those guardrails and to get them a little more objective. And there's going to be more than one factor to be sure, but industry, we now have an objective way to look at industry as part of that concentration. Like I said, we do use the OCC Taxonomy in our concentration analysis, and so it makes it really easy to do that. And then the other thing I think is when the concentration is not really a concentration and vice versa, because there are times you want to say when you don't really want it to be a concentration, you say, well, it's not really a concentration because I make it over granular, or other times when you really should be putting things together when you're not, and this helps you to do that. The other is another thing we're going to look at next year is hold limits. Right now we're kind of pretty much past the post on risk rating on hold limits, and I'd like to get more granular where we have more of a matrixed hold limit environment. So it'd be looking at the risk of the industry and the borrowers within that industry. The third issue is our portfolio analytics today tends to be based on asset quality. As I said, we tend to go into the graveyard to look at the future. And I would like to turn that into a more forward-looking analysis on where are our problems or opportunities, not to tomorrow, not where are our problems or opportunities today. And one of the factors that we can use to do that is the industry scorecard. And then, there might be other things there, and I think that one of the things we have to do as a group is to have those discussions. I was at a roundtable with other IBIS users earlier this year, and I would say there's maybe 20, 25 different banks in there, and there was a general consensus that all of us, and even the most advanced in the group, consider themselves to have underutilized this heat map. And so I think we've got a good start. I think we know where we want to go with it. We've got a roadmap to do that. And I do think there's probably some things we haven't thought about yet. And that's really all I have.
Thanks, Kirby. Here's kind of a summary of how to sequence this. I'm always asked the question of, what do we do first, and what do we do next, and how long will it take? And here's kind of a map on what you should do. And I think most of this is common sense. Is the first thing you've got to do is you got to clean and code properly your key performance indicators, your internal data, all that stuff that I showed on the spreadsheet. And then, as Kirby mentioned, you got to try to identify what the key risk indicators are. It's not always easy to do. A lot of that is more qualitative than it is quantitative, so knowing your business is an important attribute. Then determining concentration pools, you can do this from experience. We recommend at least looking at the OCC Taxonomy. Then it's good to integrate everything into early warning systems and scorecards. Scenario analysis, we didn't really talk that much about it today. It's referred to in the white paper, and that can be really cool because if you do all this stuff properly, this is almost turnkey. And then, of course, you've got to document this process for transparency. And at the end of the day, we all know that validation is really the key to all of this. And the bigger the bank you are, the more you have to do. But sometimes validation is basically just looking at some scatter diagrams and using common sense and to see if past systems worked and where they failed. That's all I have. And you know what, James? I'm going to turn it back over to you.
Thanks for that, Rick. I appreciate both your time and Kirby's time today. For greater detail regarding this webinar, we are going to be releasing a white paper, which will be sent to you after the webinar. In addition, we have an upcoming webinar scheduled for January. There'll be more details also sent out on that webinar. The topic will be alert as the credit cycle grows old, opportunities and challenges for commercial lending. Looks like we do have a couple of questions and a little bit of time to go through them. So why don't we jump right into a quick Q&A session? If you just want to switch the slide one. This question comes in, first I'll start out with Rick. On the last slide regarding sequential procedures, what are the most challenging and how do you deal with these?
Well, James, I think it really all starts with data coding and integrity. This has often been the bane of banks in their dealings with regulators. The buck doesn't stop here, but it surely starts here. At a minimum, the smartest clients do the best they can at correcting past sloppiness. A lot of the sloppiness occurred in the sell eras of loan origination. One example is certainly just prior to the financial crisis. Then as you move forward, fix up systems so that the collection processes that you have going forward, as to not introduce or reintroduce garbage in, garbage out sins of the past. Kirby, do you have any quick observations on this? I know it's a big issue with you guys.
It really does start with clean, complete data. A lot of banks have more than one source system, and that creates a problem because the source systems do things differently. It's like one source system, it sounds stupid, but one source system has a 16-digit customer code and the other has an 8-digit customer code. How do you get them to talk? The other thing, even if you have a single source system, chances are you've got your data in other places. And the most common, and I have to admit, we have a ton of it and I hate it, but the most common are those little asteroids called Excel spreadsheets. And so you do that because it's easy to do and it's easy to manage and it's easy to maintain, but it is truly little asteroids. And the question is how do you get that into a data planet? And so you can see what's going on, and that can be a bit of a challenge, but it has to be done. And the other thing I think to just add to that is that you really have to get out of these sort of backward-looking carries or confusing KPIs for carries and really trying to get forward-looking risk indicators that help you understand what's going on in your portfolio going forward.
Great, thanks for that, Kirby and Rick. One more question here. This one directed first at Kirby. What are some of the latent risks worrying you at the moment?
Oh, golly. I think there are, if I had to think about it, there's two that really kind of stand out. The first one is supply chain disruption. It really is very complex. It ranges from, the tariffs or trade issues in general. There's a lack of capital investment that's going on, and you'll see disruptions in part manufacturers, for example. So Caterpillar's had to shut down a plant because they can't get the parts. And then the other one that I think is a real hidden Mickey that a lot of people haven't thought about, and that's transportation. The United States has a nationwide shortage of 30,000 truckers. Somebody's got to move this stuff, and who's going to do that? And just sort of anecdotal, but I was talking to an HR director at a local food distributor company in my hometown, and a 21-year-old individual with a commercial driver's license can make $60,000 a year driving a truck. and that's not long haul. That's just their radius is 250 miles, so it's day haul type stuff. That's pretty good money for a 21-year-old, and that's just reflective of the fact that there just aren't any truck drivers. The other thing that I think really bothers me, and personally bothers me a lot, and that's the leverage lending market. I don't think it's a question of if it's going to blow up. I think it's a question of when it's going to blow up. And I think when it does, there are at least two things going to happen. Number one, it will continue to exacerbate the supply chain disruptions. And then the second, and especially in the leverage lending market, the leverage loan market as opposed to the leverage bond market, historically has been the purview of banks. And what's happened is there's been a lot of passive investors moved into that. And as that market starts to decline, deteriorate, those passive investors will start pulling their money out. And I think that becomes a real problem from a market liquidity standpoint. As you know, how are these companies going to continue to do business if they can't access that kind of funding? So those are kind of two things that really sort of bother me right now.
You know, I just wanted to add something that that we discussed at the September 26th webinar with Ken Brown from the CIT group. We all know interest rates are going to be on the rise, as is the cost of credit. But I think a lot of us think that the potential impacts are underestimated. I mean, I think of it this way: interest rates have been historically low since the mid 2000s. Goes back to the Greenspan era, and many businesses are addicted to cheap credit. Think of the following example of small mom and pop shops and also CapEx related industries that are very, very vulnerable. So in a nutshell, rising rates have impacts on both the credit and also market risk side of the equation. So let's keep this in mind. Too often people think of you know, interest risks being a market risk in the bank's functionality, but take a look at your portfolio, stress test your portfolio as many clients have done, and see where you're vulnerable to small businesses that have really thin margins, maybe carrying large inventories, and they may succumb to even a couple 100 basis points increase in their cost of credit.
Looks like we have time for just one more question. This one goes out to Kirby. Who completes the industry scorecard at your bank, and how often?
Good question. Well, I actually was talking to the individual who put this together, and the heat map is that IBIS provides is an Excel file, and it actually feeds into our scorecards. And so it's a fairly straightforward thing to do. The heat map, and so really the only inputs that we have to do individually are the qualitative factors. So from a heat map standpoint, we do that on a quarterly basis. The map's available monthly, but we update it quarterly just because, you know, changes are pretty minute from month to month, and I think it's more pronounced on a quarter-to-quarter basis. The qualitative factors, it kind of depends. If it's a concentration that we're following from a concentration standpoint, then the portfolio analytics group would do that. If it's sort of a one-off, you know, like a one lone wonder, then that would be done by the credit analyst.
All right, looks like we've covered all of our questions. Before we head off here, Rick, is there anything else you wanted to cover before we wrap up?
Well, I just wanted to say thanks for thanks for joining us. And the next webinar, as James mentioned, we're starting to work on it now. I'm hoping to get Dev Strychek, retired from SunTrust Bank. You might be familiar with him. He's written a couple of 100 articles for the RMA Journal, and we're actually working on a paper right now that'll be both a white paper and be published in the RMA Journal. That will be linked right in with this next webinar. So stay tuned.
Great. Thank you, everyone. We appreciate you being here. Again, please visit us at www.ibisworld.com for more information on how IBISWorld helps commercial banks. Again, thanks for joining us today, and we hope to see you next time.
Goodbye.